$50,000 in tax-free liquidity is sitting in your permanent life insurance policy right now. But one wrong move, choosing to surrender instead of borrow, could trigger a 20% IRS penalty plus ordinary income tax at your marginal rate, costing $10,000, $15,000 on the same $50K access. Most permanent life insurance owners don't realize the distinction exists. In the next 4 minutes, we'll show you exactly how policy loans work under IRC Section 72(e)(10), why modified endowment contract status changes everything, and the one calculation that determines whether your access is tax-free or taxable for life. Here's the wrong belief most people hold. If I need cash from my permanent life insurance, I just withdraw or surrender the policy. And because it's insurance, the cash value comes out tax-free. That sounds logical. It's also incomplete, and it costs high-income earners tens of thousands of dollars. The correct reality is this: policy loans are absolutely tax-free under IRC Section 72(e)(10). You can borrow against your cash value at any time, at any income level, without triggering a single dollar of taxable income. But if your policy has been classified as a modified endowment contract, triggered by exceeding the 7,702 corridor premium limit in the first 7 policy years, then any distribution or withdrawal in excess of your cost basis incurs a 20% penalty plus ordinary income tax per IRS Publication 590B and IRC Section 72(e)(11). On a $50,000 access with a $15,000 cost basis, that's $35,000 subject to tax. At 32-37% marginal rate for a high-income earner, you're looking at $11,200, $12,950 in combined tax and penalties. Same $50K from a non-MEC policy, zero tax. That's a $10,000, $15,000 delta on a single decision. Let's break down the MEC threshold. The IRS uses something called the 7,702 corridor rule. In your first 7 years of policy ownership, there's a maximum amount of premium you can pay without the policy being classified as a modified endowment contract. This limit is calculated based on the guideline premium and corridor test. It's not arbitrary. If you exceed this limit by even one extra premium payment, your policy becomes an MEC instantly, and that status is permanent. You can't go back. You can't fix it by skipping premiums. Once MEC, always MEC. Now here's where the loophole lies. A policy loan is not a surrender. When you borrow against your cash value, you're not withdrawing in the tax code sense, you're taking a loan. The IRS treats policy loans as non-taxable borrowing, just like a home equity line of credit. Your basis stays intact. You owe nothing to the IRS. But the moment you surrender the policy or take a distribution, a formal withdrawal, not a loan, the IRS applies the LIFO rule, last in, first out. All gains above your cost basis get taxed first, and if the policy is an MEC, that gain faces a 20% penalty on top of ordinary income tax. Let's ground this in a real scenario. Imagine a 55-year-old business owner earning $250,000 annually. She owns a $500,000 permanent life insurance policy she bought 12 years ago. Her cost basis is $80,000 in total premiums paid. Her cash value is now $175,000. She needs $50,000 for an unexpected business expansion, and she needs it in 30 days. If her policy is not an MEC, she calls her insurance carrier, requests a policy loan of $50,000 against her cash value. The loan is approved. She receives $50,000. The IRS sees this as a loan, not a distribution. Zero tax, zero penalty. She pays interest on the loan, typically 8% annually, but the principal and interest payments stay between her and the insurer. The policy continues to grow tax-deferred. If her policy is an MEC, because she made an extra premium payment in year 4, she tries the same strategy. But now, if she takes a distribution instead of policy loan, the IRS treats that $50,000 as a taxable distribution. Of that $50K, she's already paid $80K in basis, so the entire $50K is considered gain. At 35% marginal tax plus 20% MEC penalty, that's $27,500 owed to the IRS on a $50K draw. She nets $22,500. But here's the critical detail. Policy loans are still allowed on MEC policies. They remain non-taxable. The trap is that people either don't know this or their insurance advisor suggests just surrender and take the money out, which triggers the tax event. The fix is simple. Know your policy's MEC status before you need the money. Call your insurance carrier, ask for your illustration or policy statement, and confirm whether your policy is subject to modified endowment contract taxation. If it is, structure your access as a loan, not a surrender. If it isn't, you have both options available. For the full implementation guide and MEC threshold worksheets for your policy type, check the companion book, HSA Millionaire Hack, link in the description. The biggest takeaway: a $50,000 policy loan accessed correctly produces zero tax impact. The same $50,000 accessed via surrender after MEC status triggers could incur $10,000, $15,000 plus in avoidable taxes and penalties. If you own permanent life insurance and might need liquidity in the next 7 years, this distinction could save you a small fortune. If this opened your eyes, hit subscribe. I'm covering backdoor Roth pro rata trap loopholes in the next video, dropping Thursday. Ring the bell so you don't miss it. What's your biggest takeaway from this? Do you own a permanent policy?